Let's see here. All right. Let's I think we can probably get going here, Lee. We have a fairly full agenda, which is a nice thing, I think, for us. We've been pretty lucky, I think, in a number of ways to have the opportunity to you and I have the opportunity to talk offline a lot, and so that's always fun to be able to do. But there's a lot going on in the space for sure, and so with that, let's introduce ourselves. I guess I'm Jimmie Lenz. I'm with Duke University. I run two of the graduate programs here: the Master of Engineering in Financial Technology and the Master of Engineering in Cybersecurity.
And I am Lee Reiners, obviously also at Duke, and I am the Executive Director of the Global Financial Markets Center at Duke Law. And I have my coffee, but unfortunately, I don't have my crypto. It's all gone.
Okay.
Coffee, no crypto is what we should change it. Yeah.
Coffee, no crypto. I am still holding. I am, like any asset, it's volatile, in particular these days. I was looking across some of the other listed trading assets, and boy, this is a common story kind of across the board, as most people probably realize.
Yeah.
And so we are seeing, I think, obviously there is a lot of volatility in markets. We've had some interest rate shocks that are really significant, I think. And with those interest rate shocks, obviously people are kind of looking down the road a little bit as to what else is out there, what else is happening and going on. And so it affects crypto just like any other asset that of value. With that said, and you and I talked about this a little bit, and I'd love to get your opinion. We started this on Twitter, so this is I think it is a different kind of asset. It's traded in a very different way, cryptocurrency, and we are seeing what happens when you have an asset traded in kind of multiple places. But I'd love to get kind of your thoughts on Hester Peirce's comments, and maybe you want to kind of paraphrase those too.
Yeah. Well, a couple things. I mean, just sort of big picture, and you touched on this, Jimmie. It's now quite obvious that crypto has been trading as a risk asset for, at this point, maybe its entire life, right? I mean, we have to have some context here, which is, the first Bitcoin block was mined in January of 2009, when interest rates were at zero. And the Fed pushed them to zero, and most other major central banks pushed their benchmark rates to zero in the wake of the global financial crisis, and they essentially remained at zero for a decade plus.
Yeah.
And there were a few attempts to normalize, and then the Fed had to go back and take there's taper tantrum. And then of course when the pandemic came, the Fed pushed them to zero again. So so Bitcoin and crypto has been operating in a very unusual monetary policy environment. And if you look at just the history of monetary policy, and, of course, that contributed to the so-called search for yield, right? Fixed income was not getting you anything. And we all know this, right? From our, what we get on our savings accounts or CDs or whatever. And so, this led to risk assets, the price of risk assets going up. But it obviously hasn't just been cryptocurrencies, right?
Right, absolutely not.
And there's a number of things we can point to as sort of emblematic of, the broader macroeconomic environment. Things like, WeWork and, and other, right? I mean, and just kind of, the amount of money pouring into VC, the private markets, collectibles of all genres, not just crypto collectibles, but collectibles in general. Baseball card, trading cards, Pokemon cards have gone up quite a bit.
I would say junk bonds, probably one of the wider held.
Yeah, high yield bonds. So And so crypto has been a part of that. And so the moment that inflation reared its ugly head and people started to understand that the Fed was going to have to move, and now obviously moving aggressively, that is when the crypto sell-off, started to occur. So a couple things. Obviously, one that shattered this whole, myth, and it was always a myth that somehow crypto and Bitcoin is digital gold, right? Because gold is a hedge against inflation, or at least, isn't completely negatively correlated as crypto seems to be. So that isn't the case. So the problem now is, when do you determine, or how do you determine if crypto is oversold, right? Like, buy the dip, right? Every people say buy the dip, right? And this comes back to a point that I've made repeatedly, Jimmie, which is, with crypto, there's no fundamentals, there's no cash flows, there's no valuation methodologies that, historically have applied to traditional assets, stocks, bonds, normal currencies, things like that work with crypto. And it's an asset, in my opinion, that trades entirely on sentiment. And of course, sentiment is very, very negative right now. As long as the Fed is still having to increase rates, I think it will remain so. And there's no guarantees that sentiment will come back. Now it could, Elon Musk, I guess, could tweet something tomorrow where it's like, I like these Bitcoin prices, getting in, and then, listen, it would probably, pump up the price for sure. But I just don't know, how would you assess when the bottom is going to occur? And it keeps blowing through these resistance levels. We can talk about technical analysis, right? And for a while it was 40, and then breached 40, and then 30, and then it's kind of dangerously about getting to 20. And if it hits 20, I don't see any reason why it would stop. And not hit 10. Right.
Yeah, I think you raise a couple of good points, Lee. It is a different kind of asset. It trades in a very different way, which I think is worth taking a look at. The fact that it's a risky asset, I think we've proved that. I would agree 100%. We've shown that, but I think that was always somewhat the case. And gosh, I don't know if there's anything that, if you look at some of the volatility out there that isn't a risky asset right now. Seems like anything that you can, almost anything that you can hold in your wallet is starting to be treated that way. The spreads between high yield bonds and treasuries is at, a highest it's been probably in the last 2 decades. We're seeing a lot of movements around. That said, I think that there are still, and you and I are both participating in a conference with a lot of international people at Duke this week. There are still a lot of people that see crypto as a means of banking and things along those lines in places where they don't have a large and distributed financial type of marketplace or large financial services. The technical analysis that you were alluding to, kind of what you said at the very beginning, we've been in a very unprecedented monetary policy times over the past decade and a half now. Since 2008, the Fed's central banks, I won't even say the Fed, central banks around the world have vastly manipulated currencies to keep interest rates at zero. And that's coming home to roost. And there's no student of markets could have seen any other end. It had to end this way. I'm shocked that the Europeans actually are saying, well, let's go in and do more of this because it worked so well for the last 12 years. That said, I think that we are seeing that kind of policy come home to roost. And if you're trying to do any kind of technical analysis, it's cryptocurrencies have only existed in one environment, for all practical purposes. And so, in a more normal interest rate environment, how are they going to behave? Nobody knows. But I do think
and so let's talk about the future and kind of where things may be heading in the future, right? So if you're, crypto supporters, what they'll say is, listen, stocks over the long term do well, right? And that's true. Over a long enough time horizon, stocks go up. And so therefore, they justify then that crypto is going to go up. I don't, there's no history though that would lead you to conclude that is a given. by any means. So it's very much uncertain that it'll ever regain its footing. And then in terms of the broader market, again, if you're being charitable, you could kind of look at this as sort of being akin to the dot-com collapse, right? Of course, a lot of, hype, valuations that, just were not supported by any, basis in facts. But that didn't mean, of course, that the internet was worthless, right? I'm coming on the other side of that. You saw, genuinely innovative companies, producing, economic value, the Amazons of the world, the Googles, right? They went on to conquer the world. And so, I guess that's one way to look at it. The other is that this is like the beginning of the end, that this is sort of like the Beanie Baby moment, right? And I've always come back to the fact that for crypto to have sustained long-term value, it has to provide economic utility. The story has to be something other than the price or number go up. It has to improve a product, a service, a process that touches on all of our lives. And when I talk to, average people about, how they use crypto and blockchain and, their day-to-day life, the answer is that they don't use it. I mean, maybe they've traded it and speculated in it, but at some point it has to actually provide economic utility. Now, I know you pointed, Jimmie, the use cases in developing countries. I tend to think that those are overblown, to be honest with you. And certainly, asset as volatile as crypto is not a great store of value. So, but I think, when it comes to developed countries, it has to do something for us, right? It has to provide genuine utility if it's going to have sustained value. And I actually think, Jimmie, and I'd be curious to get your thoughts on this, that the prices going down actually might be a good thing for those who are truly interested in building things, like your students. Because when you look at the origins of Bitcoin, the Satoshi white paper, it was all about a peer-to-peer decentralized payment mechanism. Well, of course, if Bitcoin's at $60,000 and as volatile as it is, it's not a very good medium of exchange. You look at Ethereum, it was built with smart contracting functionality, so you can have decentralized applications. But again, when Ethereum was $4,000, the gas fees are way too high to actually execute transactions on the Ethereum blockchain. So, maybe this will allow builders to actually build things of genuine economic utility, and we won't get distracted anymore by the Dogecoins of the world. And the story will be something other than the price. But curious to get your thoughts there.
Yeah, no, Lee, I think you bring up a couple of good points there. First, I do think it is a somewhat unique asset class. And I mean, your comments around, the dips and things like that, or the analogy with the dot-com bubble, I don't think that's apt for a couple of reasons. I mean, we wrote a paper on that. You guys can go to my website and see a paper that we wrote on that I think was pretty good. It's just it's a simple website. The other thing, as far as the kind of the retreat in price, and will that bring the nativists back in, and will that be the builders and developers back in? I think you're right. I think there is obviously there's a ton of hype. It reminds me a ton, and you are quite old enough, but I know you've read about it, of the NASDAQ market here in the 70s and 80s in the United States. I wasn't in the 70s, obviously, but trading stuff, would have liked to have been, but probably not. But in the NASDAQ market in the 70s and 80s was just fraught with all kinds of pump and dump schemes and things that were massively overpriced, and certainly the dot-com boom had a lot of that too. And then all of a sudden you had this retreat, and you had a lot of people building, I think, substantial things. I think there is, among when you look at things that are happening, I think there are some really cool projects out there, but I think there's a lot of dumb stuff. I mean, nobody can, the Dogecoins of the world. I mean, yeah, what is that ever going to facilitate? I think the, price things like Ethereum, I mean, those, you are seeing still a lot of transaction volume out there. You have a lot of things out there that are, I think, being not only transacted on it, but being built on it. The BSV nativists will tell you, that the original code for Bitcoin had, smart contract ability and some of those kinds of things in there. And people are starting to get much more interested in that. people are starting to look back and saying, hey, wait a minute, there are these facilities. I think companies, and these are not companies that were started last week, and they aren't by people that are around. But I think companies that like Figure and Provenance that are securitizing mortgages on the blockchain and using that as a way to actually lower the cost. It's not a gimmick. It's not this cool thing out there. Mike Cagney's been around a long time. He kind of knows what he's doing. Yeah. And he says he's taken about 100 basis points of cost out of securitizing a mortgage. Well, that's how all the mortgages are basically facilitated in the United States. Yep. I think we're going to see a lot more of that kind of thing. Kind of the stuff that I did last year with the NFTs. Putting a diploma on NFTs so that it makes it much more portable, so that employers can avoid diploma fraud and those kinds of things. I see those as very sustainable. I see those as facilities that can move forward. But at the same time, I think that a lot of all the cryptocurrencies, I mean, they trade in multiple markets. They are, I think, a unique asset class. I think even you would say that trying to compare these to stocks or bonds or other things, it's not really possible.
No, it's not, and that's why I said that they're worthless. But listen, I talked, obviously, you're in this space, I'm in this space. I hear from people who vehemently disagree with me all the time. When it comes to crypto, there's a quasi-religious element to it, to be honest with you, Jimmie. And there's a lot of parallels, right? I mean, even going back to the source text, the holy book, right? The Satoshi white paper. Yeah. And then just like all religions, there are various, groups that lay claim to, being the inheritors of the true vision, right? And there's even, I think, a coin called Satoshi Vision, and Bitcoin Cash and Bitcoin Maxis and all that stuff. And so the thing about religions is they can last a long time, and you can't disprove them. So I don't think it's going away. I think, as long as there's a core group out there, it's going to stay afloat. But listen, it's defied predictions from the very beginning, right? So whatever we say today is probably going to be wrong. That's just the way this market has treated us so far.
The market has changed just drastically. The one thing in the paper, and I know, thanks for putting the link in there. The one thing in the paper that you will see is, we did try to, one of the comparisons that we did, and we did this, kind of a mathematical look at this versus NASDAQ, and we did it under the kind of the guise of the NASDAQ, the dot-com boom. One of the things that we found was that typically when markets fall, and I have no doubt we're going to see it this time, people exit markets. Retail is notorious about this, right? They are the worst indicator there is. They usually get out at the bottom and in at the top. I have no doubt we're going to see people fleeing the markets. We have not seen that kind of behavior in cryptocurrencies. We've seen just the opposite. People really do buy the dip. So we haven't seen, individuals fleeing. Maybe we will. I just don't. It hasn't been the case so far in the period that we've been able to look at. The other thing I wanted to mention, I said, Lee and I are attending a conference here. We're actually co-hosting a conference here at Duke that's bringing in a lot of people from around the world. I don't know how different countries people came from, but there were quite a number from Africa. And one of the, and even though it's not a cryptocurrency, it almost feels like it, M-Pesa. M-Pesa is very, very popular. It is banking on your phone. It's used in about 20 countries now. I can see, that sort of facility because these are people without traditional banking services, things along those lines. I really do see, that as one of the futures for cryptocurrency, and I see it in other places. I can see it in South America. I can see it in parts of Asia, where maybe even, in the Americas where people don't have access.
Yeah, I mean, this is kind of a pet peeve of mine, as you know, because another thing people accuse me of is like supporting the traditional financial sector because I'm, critical of crypto, which is, total BS. There are, of course, real problems in our traditional financial sector, in particular when it comes to financial inclusion. And, frankly, it's expensive to be poor in this country and elsewhere. but I just don't think crypto is the solution. I mean, when you look at whatever the issue may be, there's generally somewhere in the world a solution that's already being used. So you mentioned M-Pesa, mobile money. You look at what Alipay and WeChat Pay, in China, how that completely has just transformed the payments landscape there. Now, of course, with China, privacy is non-existent essentially, right? So I think whatever it may be, whatever the kind of the use case is, there's generally probably something out there that is working better. But of course, I'm not Ray Kurzweil here. I'm not a technologist, so who knows what will happen. But I think we got to move on, Jim, because we got a ton of topics to cover. So
okay, I'm gonna throw you a softball and say, okay, what's up next?
All right, what's up next? Well, Celsius. We got to talk about DeFi. Celsius. We got Warren Buffett famously said, I'm paraphrasing here, when the tide goes out, you see who's swimming naked, right?
Yeah.
And obviously the crypto tide has gone out. And so we're starting to see that a lot of these projects and platforms, were built on a shaky foundation that frankly, they could only operate in an environment where, crypto prices were high and increasing. Of course, it started with Terra USD, algorithmic stable coin, that spread. And now kind of the latest firm in the crosshairs is Celsius. So I want to get your thoughts. I think, if I'm not mistaken, I think Alex, who's with us, posted something in LinkedIn about how we should consider Celsius to be centralized DeFi. So C DeFi, I guess, is the acronym there. But for folks who maybe aren't familiar, Jimmie, just break down who Celsius is, DeFi in general. And I know you've shared my skepticism when it comes to some of these, yield platforms, right?
Absolutely. So Celsius was a company that a DeFi company, and decentralized finance is simply, financial companies that are creating or providing platforms for different types of financial services that are facilitated using cryptocurrency. So, and it can be almost anything, those platforms, but they tend to concentrate. And Celsius was one that was offering basically hypothecation of your cryptocurrency, which is the lending of your cryptocurrency, and they would, give you a portion of that. Now, this idea of hypothecation is really, really common. Every brokerage firm, if anybody has a brokerage account, your securities are being hypothecated. You agreed to that, although you didn't know it. You probably that was one of those things in that 25 pages that you kind of scan through,
yeah,
and you left everything checked. That's when you agree to it.
Well, you can request that they not be rehypothecated.
You can. But these are people in Celsius who voluntarily do this. They say, okay, I will pledge my securities to be lent out, and they were receiving these outrageous fees. And so I asked from the very get-go. I was very skeptical of this. I'm a finance guy at the end of the day. I've been in finance for a long time. And when I see outrageous fees being paid, I know that somebody else has to be paying even more. And so I kept asking, who are these people who are when, as you said, Lee, at the very beginning, rates are, basically at zero. Who the hell is paying 20% to borrow anything? Nobody. And I always said, show me these people. And they would say, go through these convoluted, well, no, you see, we're leveraging this and we're doing that. It's like, I know how this works. That's total, there's no sense made at all. The math does not work. And clearly the math didn't work because as soon as the asset started to come down in value.
Yeah, I mean, it's this kind of like circular economy, right? Where and it's totally detached from, the quote unquote real economy, where people are borrowing crypto assets to trade other crypto assets on platforms that are probably then trading other crypto assets, right? I mean, I don't think we know entirely what's going on with Celsius and kind of how they found themselves in trouble. So, just so folks are aware, you could deposit your crypto with Celsius, you would get, 18%, yield on that, and then they would, lend them out, and no one was entirely clear kind of, who they were lending them out, where it was going to. There's some kind of speculation that they might have been putting those, those deposited coins into the Anchor protocol, which was, run by Terraform Labs and was, affiliated with the Terra USD and Luna situation. So, again, it's just all this circular economy that produces no real value. And, it's confusing, but it always comes back at the end of the day to, if it sounds too good to be true, it probably is, right? And, that just applies to like crypto, in general. And listen, a lot of people, they got out, right? I mean, and this is how it generally works with stuff like this. It's the wealthy, it's the first movers, the savvy who get in and get out. And then it's the people who can least afford it that are holding the bag, right? I mean, just look at who was getting these, subprime mortgages, option arms, pick a pay, all this stuff. Leading up to 2008, it was, minority groups, people who, weren't savvy financially. And that seems to be the case here again with crypto. So it's sad, some of these stories that you're hearing about people losing, life savings, and and on some of these crypto Reddit forums, they're posting the number to the National Suicide Hotline, and it's I take obviously no pleasure in seeing any of this stuff, but but again, it was all too good to be true, man.
I think
18%.
Yeah, I mean, you had to, you couldn't in any for anybody with a finance background, with anybody who's done just a modicum of homework, you had to ask yourself how could this ever be possible? Yeah. I never, and me, I'm a big supporter of a lot of the cryptocurrency projects, but this, when people couldn't explain to me how you can pay this out, and it seems like this is one of those, and I hate to use this analogy, but it just seems so apt for a lot of these things that are going on. They feel very boiler room like. Yeah. I hear there's a phrase I hear all the time being used, and the whales are doing this, the whales are doing that. I was an institutional trader for 25 years. I never heard that used on an institutional desk. The only place I ever heard that was novices from the retail side, and it came from literally probably one of the worst movies ever made, and certainly one of the most implausible. The movie Wall Street is the first time I ever heard that used. I mean, maybe it was used before that in boiler room type operations, but whenever I hear that word used, I always think you have no idea what you're talking about. You're trying to throw nomenclature at me.
Well, speaking of things that don't make, I'm with you on that one. Speaking of things that don't make sense, Jimmie, I'm going to let you ponder John's question there in the chat while because this is kind of related here. I'll just say that just because someone works at Duke does not qualify them as a colleague, right? We'll put it that way. But I think a few coffee and crypto chats, maybe it was our last one, we were talking about Sam Bankman-Fried on a Bloomberg podcast, and he was asked to explain DeFi, and he proceeded to basically describe what was in effect a Ponzi scheme about putting money in a box and people valuing the box and this and that. I don't know if you saw this, but yesterday I saw a clip of Mark Andreessen being interviewed by Tyler Cowen. I don't know if you
No, I didn't see it.
Yeah, you should check it out. So I'm assuming most folks are probably familiar with Tyler Cowen at George Mason, The Economist. He's got a great podcast, Conversations with Tyler, and he's a really bright guy, searching mind. And so he asked Mark Andreessen to describe a Web3 use case, like one that would resonate with people. And he really couldn't. He talked about like a Web3 podcasting platform that was uncensored, and Tyler was kind of pushing back, and he's like, this isn't censored. We can say whatever we want here, And, I think it's kind of telling if the smartest, wealthiest people that are kind of pushing this stuff can't provide just a basic description that makes sense to the average person, maybe there's nothing there, right? And I think, frankly, they should have you on because you make, more compelling cases, Jimmie, than any of these, venture capital people when it comes to, genuine crypto use cases. But I mean, this is like Mark Andreessen. I mean, this is your portfolio, at A16Z. like you should have like your elevator pitch down, right?
Yeah.
And you're going on to this major podcast and you're just spewing nonsense. So I don't know, man.
Yeah,
I'm from a small town in Minnesota. You got to be able to explain it. Otherwise I'm staying away.
I come from that same small town in South Carolina. It's you do have to, and I think that if you can't explain it pretty quickly, and it's not something that somebody understands, and they can understand the real use case, you have to question it a little bit. And I know it sounds like Lee and I are agreeing on everything here, but we do agree on a lot of things that core, especially things along these lines. I mean, left to their own. So I teach in an engineering school. Left to their own devices, engineers invent really cool things. That does not mean they have a practical application. They are just really cool things.
Yeah, for sure.
It's and I think there are some of those out there. I think also we often develop technology that we don't have good use cases for, sometimes for years, sometimes ever, but certainly for years. I think there are a lot of good use cases. I think in for cryptocurrency, for blockchain, I think there are some phenomenal use cases. I really do. That are out there. I think that they're boring type use cases, though. For the most part, they're improving on things like I mentioned the stuff that the guys at Figure are doing. Securitizing mortgages. That's pretty boring. The NFTs.
But it's a massive market, though. I mean, think of the impact.
Yeah. I mean, the things that I'm doing with, for identity, for students, I mean, that's a pretty boring thing. Supply chain used to be really boring. It's not as boring as it used to be. Those kinds of things are out there. And I think those are super use cases. There are, I think, a lot of them out there, but they tend not to be, super exciting for the most part. They could be vast improvements on things that we already do, and almost everything is. I mean, hell, at the end of the day, Amazon's an improvement on a department store, right? It's not like they invented retailing. Invented a hell of a lot more efficient way to do it.
Yeah, that's right. Yeah, the future tends to unfold incrementally. So. Well, let's move on. Let's move on, Jimmie. So, I kind of punted a little bit on, I didn't punt, but got distracted with your question about, Hester Pierce and, Bitcoin ETF, crypto ETF, something that, I've been skeptical of and, supportive of the SEC stance thus far to say no. But if there's kind of a silver lining to what's been going on with crypto, is that at least thus far, knock on wood here, it hasn't spilled into the traditional financial sector, right? It doesn't appear to be threatening financial stability. Now, who knows? Maybe there's an LTCM lurking out there somewhere that we just it hasn't revealed itself yet. But thus far, I feel pretty confident that financial stability is not going to be impacted. And that's sort of been kind of one of my, major kind of areas of focus and scholarship and critiques here. And that's my background, right? Kind of where you sit depends on where you stand, or maybe I got to reverse there. As a former, bank regulator, and so that's why I've always, drawn a spotlight on these attempts to integrate crypto into their traditional financial sector. And there are a variety of ways to do that, but obviously structured products is one of them. Derivatives is one of them. And so, going back to 2017, when the CFTC permitted the listing of cash settled Bitcoin futures contracts, that was kind of a major pivotal moment in the evolution of crypto, and one that I was and remain, very, very critical of. Once that happened, I think there was an expectation amongst the market that, well, okay, now the SEC has to approve a Bitcoin ETF because we have these regulated futures contracts, right? And the SEC said, no, we're basically not going to permit an ETF on an underlying that is essentially unregulated. And they had more specific concerns around, manipulation and the underlying and whatnot. But last fall, they did permit the listing of an ETF that tracks the price of Bitcoin futures contracts, right? So the underlying in that case is an actually regulated instrument. we can kind of question the sort of the Russian doll nesting here going on. And so a lot of folks in crypto kind of view an ETF as the holy grail. And, ETFs are something that all investors are familiar with and probably have in their portfolios. Certainly, if you're indexing, if you're a passive investor, you're using ETFs, and they're great. They're fantastic. They're low cost, maximum liquidity, right? Trade throughout the day.
Yep.
And it's a great way to get exposure to, either an index or, asset classes that are hard to otherwise get exposure to. And so those reasons don't really apply to Bitcoin. And I think the fact that folks are clamoring for an ETF and other kind of derivatives, to me, is an indictment of the underlying itself as an investable asset. It's very easy to get. I mean, the whole premise of Bitcoin is that it's digital. There's no intermediaries, right? It should be super easy to acquire and transact in. So why do we need abstractions to get exposure to Bitcoin? So
I would say
I just don't see the economic purpose. I get the financial, right? Because if you look at what goes in an ETF, I mean, you have the sponsor, right? Then you have the listing exchange. Then you have the authorized participants who are trading in and out to make sure that the value of the underlying corresponds to the value of the ETF, right? And so, and all of those are intermediaries, right? And it's, one of the great ironies of crypto is that for a technology premise on disintermediating, the landscape is littered with intermediaries who are charging, in fact, higher fees than traditional bank intermediaries. So, and I think there's really systemic risk implications here also, because you can't just magically transform an illiquid asset into something that's liquid by packaging it into an ETF, right? And we've seen kind of disruptions in illiquid ETF markets before. I mean, you're a trader, so this as well. So I'm hopeful the SEC will continue to say no here. Obviously, if a Republican wins the presidency in 2024 and gets their people at the SEC, I'm sure they're going to change their mind and give the store away to the crypto sector. But for the time being, man, I think Gary Gensler is looking pretty good given what's transpired here in the crypto market, not to approve an ETF. Because just think of how many people would have lost money in that ETF, Jimmie. So that's my rant. I'll turn it over to you.
Yeah. So, well, remember, I don't know that it's that administration dependent, honestly. I mean, remember that Glass-Steagall fell under a Democrat. So so that, so I don't think it's that. I think I could go either way, but I think there's a couple of reasons for the ETF, because it doesn't trade on a central market. There is a need, I think, for an ETF-like instrument that allows for a diversification among exchanges. I think you do have that, and I don't think it's a problem as much as it's just a characteristic of a decentralized type of environment, where you have this, something, the same asset trading on different exchanges. There is no central order book. There is no, SOS type operation or DOT type of structure. So it does allow for it to be, and so it takes some of that illiquidity out of it. The other thing about an ETF is I can put that in my IRA. It's very difficult to do otherwise, right? I mean, Department of Labor is a really difficult, people don't realize that's who, by the way, the Department of Labor is actually who runs the IRA rules, or all ERISA rules. People think it's the SEC, it's not. And so, being able to do that, to have it in a brokerage account, have people, put a portion of their assets into this in a very, very simple and easy way. Because you can't do this. So I wanted to do a UGMA type gift of cryptocurrency to someone. I can't do it. That's not allowed, right? There's no facility to do something like that. I think that there are brokerage firms that are kind of moving away from that. Abby Johnson famously, has allowed Bitcoin at Fidelity, and they've talked about expanding the number of cryptocurrencies that are going to be available, but they could make it much easier. And I think the ETF does just that. The other thing I think an ETF would do is it would facilitate a better derivatives market. And I know I've said this before, and I've said it on this on this podcast before. But that was one of the stakes in the ground that came about when the U.S. left the gold standard back in the early 1970s. Very famous Milton Friedman came out and wrote two papers on the need for an immediate derivatives market to keep the volatility, to hedge some of the volatility out of the U.S. dollar.
Yeah.
I think that an ETF would definitely facilitate that kind of thing. I would love to see derivatives traded on exchanges and things along those lines. Right now, the derivatives that are available on some of the decentralized exchanges don't really have the liquidity I would say they need, and part of that is because these are smaller, less capitalized market makers and things along those lines. So I think it would bring about some pretty huge changes, and it would allow people to diversify their portfolios.
Yeah, I'm not disagreeing with that, and I see we got a comment here from the VC side. I mean, of course, an ETF is going to be more liquid than the underlying. I mean, that's just the nature of ETFs. So I think from my standpoint, just because we can do something doesn't mean we should do something, right? And by approving an ETF, you're now integrating crypto into the traditional financial sector. So problems in one is going to spill over into the other. An ETF is the quintessential example there. You mentioned IRAs, 401ks. Obviously, Fidelity announced last month or 2 months ago at this point that they were going to permit investors in their 401k plans, provided their employer permits it, to put up to 20% of the plan in Bitcoin, and they're currently kind of locking horns with the Department of Labor. Again, that's a classic example of, well, just because you can do something doesn't mean you should. I mean, what I tell my students, and I teach at a law school, so it's not an investing class, but when it comes to crypto, treat it like you're going to the casino. Don't invest more than you're willing to lose. Don't bring more than you're willing to lose. And I think this is just a matter of, philosophies. Conservatives tend to say, caveat emptor, right? Let people invest in what they want to invest in. I tend to take a bit of a different approach. I do think that regulators and the government have an obligation to ensure that folks are saving for secure retirement. They're not getting taken advantage of. I get that there's a line there. It's kind of a gray area for sure. But these are not assets that average people should be putting their retirement in. I mean, absolutely not. And there's no, again, I don't know about you, Jimmie, but things that I invested in my 401k, I expect to go up over the long term. I don't know where that expectation would come from in the cryptocurrency context. So again, all the people clamoring for these things are the intermediaries who are going to get fees out of them. So I just want people to keep that in mind. So there's another derivatives topic I want to get your thoughts on,
Sure.
Jimmie, and one that I think that you've talked about in the past, and I think have probably deep experience in, given your time in the markets, which is the FTX non-intermediated clearing proposal. Now it's a bit technical, so I'll do my best to kind of break it down for folks. And I had the privilege, I guess, of attending a roundtable at the Commodity Futures Trading Commission a few weeks ago to hear and debate this proposal. In fact, I was sitting just right behind Sam Bankman-Fried, who did wear a suit with sneakers, no tie though. So he did dress up for that one. And so for folks who maybe aren't all that familiar with derivatives markets, the way it works is, you have the end user, the investor, right? And they place their trade generally through a broker. JP Morgan, Goldman Sachs, whoever it may be, Robinhood on the retail side. Then that broker will, route that trade either to an exchange or to a market maker, or whoever it may be. And then once that trade is matched, at the exchange, it gets put to a clearinghouse. And most large exchange operators also own the clearinghouse as well. So for instance, ICE, Intercontinental Exchange, they own the New York Stock Exchange, a handful of other exchanges, they also have their own clearing operation. Same with CME, Chicago Mercantile Exchange. And a clearinghouse is simply a buyer to every seller and a seller to every buyer. So a clearinghouse guarantees the performance of both sides of the trade. And it takes a lot of the risk out of the system of that we saw kind of blow up in a big way in 2008 with the counterparty credit risk. Now, of course, it concentrates all that risk in one entity.
Yeah.
So, they have to manage that risk, right? And historically, the way they've managed that risk is sort of by mutualizing losses. So if there's a default, if one counterparty defaults, then essentially every member of that clearinghouse and all of the broker dealers are essentially members of the clearinghouse. Then they have to kind of pony up a little bit to make the other side whole, right? That's generally at a high level how it works historically. FTX is trying to upend that model when it comes to crypto derivatives, and this is a product that right now exists primarily in the overseas. But Binance offers them, FTX overseas offers them. But what FTX wants to do is that they want to essentially be both the exchange and the clearinghouse, and they're going to get rid of the intermediaries. They're going to get rid of the brokers, and then the brokers are also the ones who kind of collect margin from the end investor too, right? So if the position moves against you, the broker calls you up, sends you an email, says, hey, you got to give us more margin. Then they post that margin to the clearinghouse, right? That's how it works. So what FTX wants to do is they want to get rid of the broker entirely. So the investor trades strictly on FTX. You have to pre-fund your account. So you have to have money already at FTX. And then they're going to do real-time 24/7 margining. So if the position moves against you, they're going to then take margin from what is in your account at FTX, okay? And they're going to margin every, couple seconds. They're going to do this, all automated algorithm. And if you don't have enough funds in your account, then FTX will automatically liquidate you. So you'll be sold out of your position. Again, all algorithmically. Right, so that's how it works. So it's really, at a high level, to summarize, replacing intermediaries that have historically, done this margining function with algorithms. So let me stop there. Jimmie, feel free to add anything to that explanation. But then, what are your thoughts on this model as a whole, both pros and maybe cons?
Yeah. So this is not dissimilar from what happens today, in particular in futures trading. Other trading, it's a little bit different, but futures, because if anybody's traded futures, you know that your leverage is usually 20-to-1 or thereabout. So you're margined every day. So you have a kind of a call every day. They true you up every day. And if you're a broker with those kinds of accounts, you're running scenarios all the time and things like that. I love the idea. Doing this in an automated fashion is fantastic. I think having it all in one place, again, isn't that unusual. If you look at places like the BVMF Bovespa in Brazil, which basically lists almost everything in South America on the exchange, they kind of do it all in-house. If you look at the cryptocurrency exchanges, you look at Binance or you look at Coinbase or Gemini, they kind of act in several ways, right? They act as a broker, they act as an exchange, they act as clearing and settling mechanism, and they can act as a custodian sometimes. And they've taken a lot of the risk out of things. So the risk that regular brokerage firms have to pay, that DTCC calculates every day, that no longer exists, because everything is everything basically happens simultaneously. There is no delay like there are in listed securities. In the case of derivatives, those are open for a long time. Those can be open for seconds, days, weeks, months, even years, right? In the case of like a leap or something like that. And so this idea of truing it up, I think, is a great risk algorithmically is a great risk mitigation technique. People are you won't experience the people being massively underwater in things. I mean, one of the things that I saw all the time working for brokerage firms, and I only worked for one retail firm in my history, but I saw this on a pretty regular basis, where people would be trading options, and with fairly small accounts, and they would get assigned an option. On Friday afternoon, something ticks wrong and it goes against them, and all of a sudden they have a call for $2 million. These people have $2,000 in their account. Where are they going to come up with $2 million? They're not.
Yeah, I mean, this is a good point, Jimmie. And I think, what FTX is saying is like, listen, from a customer standpoint, there's a limit, right? They can only lose what they have in their account, right? So, so I don't think there's a real risk of someone kind of losing their shirt. I mean, of course, derivatives trading is always risky business. I don't think these are appropriate products for retail investors. I also kind of worry about, again, the systemic risk implications. Crypto's tightly correlated. It's easy to envision you have some type of mass liquidation event where everyone basically, kind of the computers just go haywire, right? As we've seen sometimes with flash crashes, and kind of how that spreads. I think, Jimmie, we got someone put a chat message. I think it was just to me. I believe it was Frank who asked about some of these centralized exchanges disclosing that customer funds may not be guaranteed return in the event of a bankruptcy, and our thoughts on that. I mean, listen, this is a function of the lack of regulation, and I don't think we'll have time maybe to get into the Lummis Gillibrand bill, which was making news, but that, hey, we'll put it on the agenda for next time.
Yeah.
Coinbase was kind of the first to do this in their 10Q a few weeks ago. And I've said this before on this chat, Jimmie, Coffee and Crypto, is that when you trade on Coinbase, when you buy Bitcoin, there is not a corresponding transaction that is made to the Bitcoin blockchain. Coinbase is maintaining a ledger, just like banks and brokers maintain a ledger that's indicating your balance. And because these are essentially unregulated asset classes, there's no restrictions on commingling and segregation and all these things. And so, they were forced because of that to disclose that if Coinbase fails, you would become an unsecured creditor and you would have to get in line, which of course is very different than if you use, Schwab or whatever, a brokerage account to trade stocks and bonds, where, there is some protections in place. There's a, SIPC and whatnot. So, again, I think this points to why we need to improve regulation when it comes to crypto. I don't think the Gillibrand Lummis bill is the way to go. I would say that it's an improvement over the status quo for sure. So if it's the only option, I guess that sign me up. But I think there are other options. Jimmie, we got 6 minutes left. I think we want to tease something, right?
Sure.
All right. So do you have the site? Do you want me to? I have the
Go
site
ahead.
here.
Go ahead. No, I don't have it up. So go ahead.
Oh, you got to give me the co-hosting here. You got to give me co-hosting privileges.
Here you go. You got it.
To share my screen.
There you go.
Okay. So Jimmie and I have been working on something coming up in the fall, September 9th and 10th. We are hosting Digital Assets at Duke, a conference that everyone is invited to, provided you're willing to pay the fee, to come and hear about the latest in digital assets, not just crypto. I mean, our goal for this is really to kind of bring some academic rigor, tone down the hype. I mean, we've all kind of probably attended or heard about, various crypto conferences.
This is not one of those.
This is not one of those. This is not, we're not here to all, celebrate and pat each other on the back. But we're really going to take stock and dive into some of these issues, around NFTs and stable coins and whatnot from both the builder, investor, and regulatory perspective. So super excited about this. Encourage folks to check it out. The website just launched. Registration is not even open yet, but I'll put a link to the site in the chat and just want people to take note here.
Yeah, no, this is we as Lee mentioned, this is something we've been working on for quite some time. We are our target audience is industry participants, regulators, and some academics. We will have we're actually have a call for papers that we'll have some sessions that will be running concurrently. So you have some choices as far as different sessions to attend. I think it is going to be certainly a little bit different than most of the conferences in the digital asset space. We don't have any vendors selling things. There probably will be no Lambos parked out front. Very few guys wearing baseball hats backwards. Not trying to characterize anyone, but if their characterization fits. This is going to be a little bit more academic in nature. What we do plan to do is have a really nice forum for industry people and regulators to talk, as well as participants talking amongst themselves. And so we will be announcing some of the speakers soon. We have a few regulators that have already agreed to attend. That people will be, I think people will be glad to have an opportunity to hear in person. And so, yeah, we're looking forward to it. 9th and 10th here in beautiful Durham, North Carolina.
Absolutely. So more to come, and we're adding new speakers, every couple of days. So check it out. All right, maybe one question. We got
one question. One more question.
One question from the audience. Better be a good one.
Yeah, it has to be a good one.
Because we can either raise your virtual hand, your Zoom hand here. Let's see if we can. Come on, there's got to be something here. Or did we miss any in the chat, Jimmie?
I don't think we missed any in the chat. I think you and I were kind of answering quite a few as they came up. I mean, one person asked, and it was an interesting question. John Fenders asked, what Bob Schiller would think of this, given his treatise on such things. Yeah. And so and I think that I went back and forth with him a little bit about this, but the whole idea, and I think it could be Bob Schiller, it could be any one of a lot of folks who are proponents of different sorts of investment theory, in particular diversification of assets. I'm a huge believer in that. You don't want to put all your eggs in one basket. Yeah. I think diversification of assets is always a smart thing. I would never, as a big a fan of crypto as I am, I would never put all my assets in there, because I wouldn't put all my assets in anything. It just doesn't make any sense to do that. No matter how I think how much faith you have in something, you still want to diversify yourself, because as Lee and I talked at the top, and keep this in mind, everybody, we are going into what for a lot of people, somebody in their 30s, we are going into an unprecedented time in their investment considerations. They've never seen what we're going to have. We're going back to what people in my age think are probably normal interest rate environment, where home mortgages are 6 to 8, 9%. That's normal over a period of time. And people now are saying, well, that's outrageous. How can that happen? Well, that's what happens with markets, cyclical markets. And so we are going to see cryptocurrencies perform in a brand new, essentially a brand new market, a brand new economic environment. So I don't know if you want to leave us with a couple of.
Well, we got one question. We got Yiping. I don't know, probably butchering that, but she's got her hand up.
Yeah.
So go ahead.
Okay.
Go ahead.
So a little bit about sales and its crisis. So I would like to extend it a little bit, because in this week we have a lot of liquidation, and the major thing is the Three Arrow Capital. Three Arrow Capital is one of the top venture capital in the industry, and they face the problem of liquidation. One major cause may be the Luna crisis, because they invested lots of Luna. And as a venture capital side, we are worrying about if Three Arrow Capital is liquidated. So what will be the influence to the whole industry, because it has lots of collaboration with other financial institutions or venture capitals. For example, BlockFi, it is similar to Celsius, and BlockFi connected closely with Three Arrow Capital. If Three Arrow Capital go to bankrupt, then BlockFi will also go to bankrupt. And
Yeah, I mean,
Yeah.
no, it's a great, I think it's a great question. I wish you would have brought it up a few minutes ago, but it's a great question. I mean, this is what happens to financial firms. Financial firms are, they do, things do happen, right? The probably, in my mind, the one that always comes up when questions like this comes up, although they had exponentially more exposure to the world, is long-term capital management. LTCM is probably the poster child for these kinds of things, as far as the ramifications of those. Now, this does not have near that kind of an impact. These are big venture capital firms, but they don't have that kind of influence. Would it be bad for that sector? Yes. Would it be devastating? No. That's my those are my thoughts. I mean, Lee, what do you think?
Yeah, I think that's right. I've been reading a little bit about Three Arrow Capital. Again, I think you're going to see more firms, fail or have near-death experiences. That one of the problems of crypto is that because it's not regulated, we just don't have a lot of visibility into exposures. The amount of leverage in the system, interconnections, and so. This story is not done by any means, and Three Arrow Capital's in the crosshairs now, and and it's going to be someone else next week. This is an interconnected market. So again, my hope is that it doesn't spill over into the traditional financial sector and threaten real economic activity, but no guarantees. So maybe we can leave it there, Jimmie.
Yep, I think we have to leave it there. Everybody, thanks very much. Great questions as always, and look forward to seeing you on the next episode. When you have a chance, check out the Digital Assets at Duke webpage.
Awesome. Thanks, everyone.
All right,
Thanks,
take care.